Should you be adding Ethereum to your portfolio? Well, that depends on a number of factors. One of these is whether you think it's fundamentally undervalued. Now, this is easier said than done. Indeed, how do you actually value a decentralized and programmable blockchain? It is nigh on impossible to get a clear-cut answer. That's because crypto assets are so new that there isn't yet a generally accepted method to value them. So, that got me thinking, what are the fundamental valuation drivers for Ethereum, and what metrics should you be keeping an eye on to give you an edge over the market? My name is Guy, and this video is the first of a two-part series focused on valuing ETH. Today, I'm going to focus on Ethereum network demand as a key valuation driver, and I'll be exploring that through the lens of the FAT protocol theory. I'll also look at the top network demand metrics and share the best tools to read them, so be sure to stick around. Before I get cracking, there are a few things I need to say. I never did a course in financial advice, so I am clearly not qualified to give it. This video is purely for educational purposes only. Please be sure to consult your financial guy before making any waves in crypto. Also, as mentioned, this is one of a two-part series. In my next video, I'll be looking at investor demand and market metrics. So, if you've not already, be sure to hit that subscribe button. Also, turn on those notifications so you can get it the moment it hits the tube. Locked, loaded, and good to go? Great, let's get into it. I'm going to first go over the FAT protocol theory in depth. Feel free to skip ahead with the timestamps provided below if you want to skip ahead to my metrics. So, what the heck is FAT protocol theory and why should you care? First off, this is probably one of the most important valuation concepts in crypto, so much so that it actually forms the backbone of my personal crypto investment philosophy. The theory was initially popularized by Joel Monegro over at Union Square Ventures. To understand what FAT protocol theory is and why it's important, we need to look back at how the internet was built. The previous generation of shared protocols included the likes of TCP and SMTP. What these shared protocols allowed was functionality that was reliable and scalable. In a nutshell, all the functionality of the internet that we use today relies on these protocols. That includes things like sending emails, Facebook messages, and so on. Without them, the internet would simply not exist. So it's no exaggeration to say that these protocols created immeasurable value. However, what is key to note here is that protocols like TCP failed to capture any value. I mean, if they did, then their creators would probably head the Forbes Top 100 Rich list and be household names. So, where was the value captured when it comes to the current internet? Well, it was in the application layer. That's the likes of Google, Facebook, and Tencent. The key question here is why? Well, put simply, it's due to these applications generating and capturing huge amounts of data. Think about it. When you use WhatsApp, what do you want? You want the data. When you check your email, you want the data. What happened is that companies like Google and Facebook continued to grow and started achieving these phenomenal valuations because they were the ones providing the services and functionality to internet users. All those services like Google Docs or search engine queries generated vast amounts of data that these companies then controlled and used to monetize. This meant that value escapes at the protocol layer where it's created and flows to the data providers and marketplaces. That's guys like Google, Facebook, and Amazon. To better explain all that, I want to show you the Open Systems Interconnection model. This basically shows you how the different layers of the internet communicate with each other. The important thing to note is that all 7 layers work together. So, the physical, data link, network, and transport are all the lower layers of the internet. Internet protocols mostly sit in either the network or transport layers. What's interesting is that the value always goes to the top application layer. To be clear, when I say value, I mean money. What all this means is that the current internet is made up of skinny protocols which don't really capture any value, and a fat application layer which captures almost all the value. So, how does that all change in the cryptoverse? Well, the relationship between protocols and applications is reversed in the blockchain world. According to fat protocol theory, value concentrates in the protocol layer, and only a fraction of that value is passed on and distributed to the application layer. So you have a skinny application layer and a protocol layer fat in value. There are a couple of reasons why this happens. First, you have a shared data or protocol layer. This includes all the benefits of using distributed ledger technology like immutability and publicly available transaction data. Secondly, we have cryptographic tokens to access this protocol layer. An example of this would be ETH for the Ethereum protocol. ETH has value because it is required for the Ethereum protocol layer to actually function. In addition to that, we also have speculative tokens attached to the Ethereum protocol, and these would be things like ERC20 tokens or non-fungible ERC721 tokens. Another way that blockchain value capture differs from the internet is that applications cannot gain full control of any data generated, and they don't have full custody of it. So, when we think back to the regular World Wide Web, companies like Facebook don't want to share that data they have. Also, the scaling systems for these applications are not shared at the protocol layer either. An example of this is PayPal's use of something called high-efficiency reliable access. This data access gateway is what PayPal uses to scale database access for hundreds of billions of SQL queries a day. Yes, that is now open source, but it wasn't always that way. What all that means is that applications on Ethereum simply cannot value capture to the same extent as applications on the internet, given that most of that data is publicly available and recorded on the blockchain. The benefit of not having these walled gardens of data being controlled by any single company is that it forces the market to find ways to reduce costs, build better products, and to innovate. So, many of you will know that Ethereum has spawned literally thousands of different projects with an ERC20 token. When the likes of Maker have success in DeFi, who benefits? Well, Maker does, and so does Ethereum as the protocol layer. So, according to fat protocol theory, value trickles down in the crypto space from applications to the protocol. What's important to understand is the process of this value capture when it comes to Ethereum. So, when ETH or an Ethereum-based token appreciates in value, it draws the attention of early speculators, entrepreneurs, and developers. As those people come in, they actually become stakeholders in the protocol itself and have a financially vested interest in seeing the protocol succeed. What that means is that Ethereum-based projects like Kyber Network have an incentive to see Ethereum succeed as it is the underlying protocol. All that creates a positive feedback loop that strengthens the underlying value of Ethereum. Those initial speculators, entrepreneurs, and developers also become the protocol's brand ambassadors and build communities around that shared protocol and start launching products and services. Some of those applications may become wildly successful and bring in new Ethereum users. For example, if the Ethereum-based project Engine partnered up with a giant game developer like Rockstar Games, and the ENJ token was adopted amongst tens of millions of gamers, then this would also bring Ethereum tens of millions of new users. So that's an example of how this feedback loop works between the application and protocol layers. To sum it all up, protocols in crypto accrue more value than the sum of all the apps actually being built on the protocol itself. That's because the success of any application leads to further speculation at the protocol layer and creates additional value for the underlying protocol. All that makes a lot of sense to me. After all, if an Ethereum-based project gains a ton of users, then they also become Ethereum users and increase the usage of the network. If we're to accept Metcalfe's law, then the greater number of users a network has, the more value it has. Another thing to bear in mind is that this value creation is not linear and is instead squared. All that means is that as Ethereum's adoption and usage increases, then so will its underlying valuation. So that's the fat protocol theory. I know that's a bit of a mouthful, so I've linked to some additional resources below that could help you out. Anyways, now you know how Ethereum captures value, but what metrics should you be looking at to help anticipate future value capture? I now want to move on and share my top 10 Ethereum network demand metrics to help you make that call for yourselves. So, at number 10, I have one of the most common and perhaps most controversial: market capitalization. This basically shows what the market dictates Ethereum's value to be at any point. That's relevant when it comes to pricing and the value of a currency's circulating supply. So, why is it controversial? Well, it's easily manipulated, especially for those lower cap altcoins. Market cap is simply the price of a coin or token multiplied by its outstanding supply. Using a trivial example, let's assume that a crypto called Guy Coin has 100 million Guy outstanding. However, no one really trades it, and I made the last trade with a mate for $10. According to the market cap, my useless cryptocurrency would then be valued at $1 billion. Now, with highly liquid altcoins like Ethereum, this is less of a concern. But it is important to point that out before you guys go all in on some random shitcoin. But why is market cap useful for valuation? Well, it gives a rough idea of what the market is valuing the Ethereum protocol at. It's also useful for you to determine whether Ethereum is fairly valued based on some of the other metrics that I'll talk about in a bit. Lastly, it allows you to compare this ETH market cap to those of other highly liquid blockchains, basically a rough rule of thumb. So, what's the best tool to track all that? Well, yes, CoinMarketCap is very popular. However, I actually personally use an alternative called CoinGecko. What CoinGecko shows is that ETH was once priced at over $1,400 a coin, way back in January 2018. What's interesting is that Ethereum has had a ton of technological development done on it over the past 2 years and is worth a fraction of that value today. What this shows is that crypto markets can be exceptionally irrational at times, and that the ETH price you see today isn't necessarily fair market value. Another advantage that CoinGecko has over CMC is that it has a user-generated sentiment poll, which is pretty useful for working out how people feel about ETH on any given day. It also has more detailed social stats for the likes of Reddit, Twitter, and Facebook. You can use all that information and combine it with that market cap data to get a better feeling for the coin. Oh, and speaking of market cap manipulation, CoinGecko has their own unique screening methodologies that try and filter out those bad apples. They also take a look at any coins that have been potentially wash traded and remove them from the rankings. There are a host of other tools and features over at CoinGecko, and I can't go over them all here, but I do encourage you to check them out. My ninth Ethereum metric is decentralized exchange, or DEX volume. First off, what is a DEX and how do they differ from regular exchanges? In short, these cryptocurrency exchanges allow crypto holders to exchange coins or tokens directly with each other on-chain. So that means that, unlike centralized exchanges, users don't have to hand over custody of their funds to the exchange. Now, there are a ton of people in the cryptoverse that believe DEXs are going to be one of the next biggest things in crypto, and that they even have the potential to wipe out centralized exchanges in the future. That's a bold claim, but even if it only captures a small share of the $100 billion in crypto trade volume every day, it's sizable. Then, as DEXs continue to gain market share, then the protocol they're built on should increase in value. Ethereum actually has around 15 DEX applications built on top of it, so it might be a good idea to keep an eye on those. What many people don't know is that Etherscan offers a plethora of Ethereum stats, and one of those is stats on the top DEXs. With Etherscan, you can see the total number of transactions carried out on each Ethereum DEX over different time periods. So we can see here that there have been over 33,000 transactions on Uniswap over the past week. The tool also shows you a nice pie chart with a breakdown of the market share for each Ethereum DEX. Now, that's pretty useful if you want to do some deeper research. Put very simply, if the number of DEX transactions on Ethereum is increasing, then that would be an indicator of increased demand for the Ethereum network, at least when it comes to DEXs. In theory, the more DEX transactions there are, the more value Ethereum should capture. My eighth top Ethereum stat to keep on your radar is the Ethereum-based stablecoin supply. If you've not heard of the term before, stablecoins are pegged one-to-one with a dollar, and they are widely used by crypto traders. Now, there are a ton of different Ethereum-based stablecoins like DAI, USDC, Tether, Pax, etc. I'm afraid I am still to find a tool that shows the combined market cap of all Ethereum stablecoins. However, you can Google around for articles telling you the combined market cap for these. Or if you're really committed like me, you can draw up a list of all Ethereum stablecoins by using the Etherscan token tracker. Here you can scroll down to all the coins priced very closely to $1. You can then easily spot the stablecoins on that list and add up their market cap from that column. As stablecoins are primarily used for trading, the total supply serves as a useful yardstick to measure Ethereum's growth against and gauge the demand for the network. The seventh Ethereum metric you need to watch is the value of ETH locked up in DeFi smart contracts. So, what is DeFi? In a nutshell, decentralized finance takes components of traditional finance and decentralizes them by removing middlemen and replacing them with smart contracts. A straightforward example of this is decentralizing loans and earning interest. If you want to learn more about that, then be sure to check out my dedicated DeFi video right here. The likes of Grand View Research predict that the digital lending market alone could be worth over $15 billion per year by 2026, and that's just a single element of DeFi. All that means is that DeFi is an emerging crypto sector with a ton of potential. The tool that I like to use to keep an eye on the size of that market is DeFiPulse.com. Here you can see that there is nearly $1 billion locked up in DeFi right now, and that Ethereum has a dominating market share in this area. As the total locked value of ETH in DeFi projects increases, that indicates that Ethereum is capturing even more value. The huge amounts of ETH locked up in DeFi also reduces the tradable Ethereum supply, and that's usually good news for the price too. At number 6, I have Ethereum gas use. For those that don't know, gas is used to power the Ethereum network. It's used to pay for transactions as well as for dApp computations by the Ethereum virtual machine. In short, the more the Ethereum network and applications built on it are being used, the more gas is used up to power those applications and transactions. So how does that link to valuation? Well, the more that the protocol is used, the more its theoretical valuation should be according to FAT protocol theory. You can find out how much Ethereum gas is actually being used up at glassnode.com. Right now, you can see that gas usage is at an all-time high. Pretty interesting, given that ETH pricing is nothing like what it was back in early 2018. Of course, not all gas users are created equal, so this then brings me on to my 5th top metric, the biggest Ethereum gas users. To get a quick overview of who is guzzling that gas, you can head on over to ethgasstation.info. So, why is this a metric worth keeping an eye on? Well, not all network demand is valuable. Some useless smart contracts spam the Ethereum network with utterly pointless transactions, or you even have scams like MMM using a ton of Ethereum gas. Useful network demand like DYDX and Kyber network certainly add value to the Ethereum network and the underlying protocol, whereas scams like MMM certainly do not. The 4th Ethereum metric to keep your finger on is the value of the non-fungible token market. NFTs are essentially digital collectibles. They are cryptographic tokens that represent something unique. This could be something like a special in-game item. Right now, they're perhaps crypto's best shot of being adopted within computer games, and that's a multi-billion-dollar market right there. Nonfungible.com is a website that shows you the actual size of the NFT market, and what's even better for ETH holders is that Ethereum currently dominates this promising crypto sub-niche. Honestly, the NFT market has the potential to bring millions of new people to the Ethereum network, and that's why I feel it's one of the top metrics to watch right now. At number 3, I have Ethereum daily transactions. Put simply, this metric shows how popular Ethereum actually is and how much activity there is on the network. You can check this out on Etherscan, where you'll find a handy chart. My second hot Ethereum metric is the number of wallets with more than 32 ETH. So, why is this stat worth monitoring? Well, Ethereum is going to be moving over to proof of stake when Ethereum 2.0 is finally released, and you need 32 ETH to run a validator node and get those staking rewards. People are now stacking more than 32 ETH in their Ethereum wallets to make sure they're in line to earn those staking rewards when Ethereum 2.0 finally lands. Now, you would only want to stake ETH if you believed in the future of the network, and that's an interesting metric which is an indicator of confidence in its growth. Right now, over 118,000 wallets are holding more than 32 ETH, and the number is continuing to rise. You can track it all at glassnode.com. Another thing to bear in mind here is that staking effectively takes Ethereum off the tradable market. That shrinkage of tradable supply should, in theory, mean good things for price. My final Ethereum metric to watch is active Ethereum addresses. In short, the more active Ethereum addresses there are, then the more the Ethereum network is being used and the greater the theoretical value of the network is. Alright guys, that's my roundup of the top Ethereum valuation metrics I'm monitoring right now. I've popped links to all the tools mentioned in the description below, so be sure to check those out. The truth is that there is no widely agreed upon method to accurately value any cryptocurrency right now. We're honestly not completely sure how and where value is captured in a network like Ethereum. But that's where I think Fat Protocol theory adds value in deepening our understanding of all that. Yes, it is just a theory, and it may turn out not to be true. However, in my book, it's one of the most important valuation concepts in crypto right now. And it has certainly shaped my own personal crypto investment strategy. Honestly, I think the known unknown of accurately valuing cryptocurrencies is part of what makes it so damn interesting. If you discover a method of valuation that others are yet to land on, you have an edge on the wider market. After all, if there was a magic formula that could accurately calculate the fair valuation for Ethereum, then this would severely reduce the profit-making potential of ETH and any other cryptocurrency for that matter. In the end, no single metric will tell you if Ethereum is over or undervalued from a network demand perspective. However, if you take multiple metrics together whilst combining all that with Fat Protocol theory, you can increase the probability of making the right call. Now, I know there was a ton to take in there, so nice one on making it this far. I really do want to hear your thoughts though. What do you think about Fat Protocol theory? What do you think about those Ethereum metrics I'm watching like a hawk, and are there any others that I've missed? Finally, thank you for watching, and don't forget to drop me a like if you found this video useful, and smash that subscribe button if you want to see the second part of this video series where I'll focus on Ethereum valuation based on investor demand. Guys, I have to level with you. That was not all I wanted to share. Basically, time sometimes escapes me and I can't cover everything I want to. However, this is the prime reason for my weekly newsletter. It's my short and sweet take on the crypto markets and projects making waves. I also look at some news that may have flown under your radar, as well as some juicy coin tips. Now, you have an opportunity to join. Simple instructions. Head on over to the description right now. There you'll find a link to the sign-up form. Enter your email and submit. It's really that simple. So, don't delay. My next one is locked, loaded, and ready to go.